Hi everyone, today I'll be speaking about the controversial Senate Enrolled Act 1, also known as Senate Bill 1. You might have already heard a lot of things about it, but my goal with this video is to analyze its effects on the communities of Clinton County, Indiana specifically, with some numbers of course. I'll be using a lot of data from Frankfurt, but this video will still be relevant to every town or city in Clinton County. Senate Enrolled Act 1 makes sweeping changes to local income taxes as well as property taxes, which will have a ripple effect on all of our public services. It's hundreds of pages long, so we won't be going over everything, and I apologize for that. But before we discuss what this bill means for the future of our communities, we have to look at how our taxes currently work. In 2018, the Institute on Taxation and Economic Policy wrote that the lowest income 20% of Indiana taxpayers who earn an average income of $11,400 per year contribute 12.8% of their income in state and local taxes. Furthermore, for the next 20% of taxpayers whose average income is $27,800, state and local taxes account for 11.3% of their income. Meanwhile, the top 1% of households, a group with an average income over $1 million, contribute just 6.8% of their income in state and local taxes. ITEP describes themselves as a nonprofit, nonpartisan tax policy organization that conduct rigorous analysis of tax and economic proposals and provide data-driven recommendations to shape equitable and sustainable tax systems. I recommend reading ITEP's article, but I'll try my best to summarize why there's such a disparity in the amount of taxes the lowest 20% pay and how much the top 1% pay. Indiana is a low flat income tax state. In order to make up for a low income tax rate, Indiana has sales and excise tax rates that are higher than the national average, which disproportionately affect lower income families. At the time ITEP wrote their article in 2018, the state income tax rate was 3.23%. As of today, the state income tax rate is 3%. The local income tax rate varies from county to county, but is often in the mid to low 2% range. While the income tax rate has shrunk since then, the gap between how much the bottom 20% pay in taxes and how much the top 1% pay has only grown. According to ITEP, as recently as 2024, for a family in the bottom 20% of earners, a total of 13.3% of their shared income went to taxes. In contrast, it was only a total of 6.2% for a family in the top 1% of earners. In addition, in 2024, families in the bottom 20% paid a total of 4% of their income in property taxes. For those in the top 1%, it was only 1.4% of their total shared income. That trend is likely to continue in my opinion. So just to reiterate, a low income tax means that other taxes must be raised to make up for the lost revenue, unless you have no intent in making up for it, which would mean public services would need to be cut. Mike Braun, our governor, has told local governments to do more with less. So maybe that's exactly what he wants. Who needs a helipad at the expense of taxpayers after all? I mean, other than Mike Braun. Anyway, now that we understand how our current taxes work, we can discuss the changes under SEA1 more in depth. Currently, the local income tax rate for Clinton County is 2.65%. It's well below the maximum rate of 2.9% that SEA1 will establish, but it is high when compared to other counties. The information I've seen online about this change is vague and conflicting, so I want to clear it up really quickly. Essentially, of the new maximum rate of 2.9%, 1.2% of it can only be imposed on those living in a municipality that has a population lower than 3,500. Municipalities with a population greater than 3,500 will be able to impose their own income tax rate not to exceed 1.2%. So while you might hear that the total rate you pay in income taxes could exceed 2.9%, I just don't believe that that's true based on the language of the bill. Continuing on, SEA1 will bring a new property tax relief credit equal to 10% of a homeowner's tax bill up to $300. I know many residents have voiced their concerns about their property tax bills. In addition, local taxing bodies will be able to set a new local income tax rate of up to 0.3% to raise money for property tax relief for homestead properties in particular. But I don't think it'll be utilized due to the previously detailed credit. As mentioned before, property taxes take a larger chunk of money from a lower income family than from one earning a higher income. On the other hand, ITEP concludes that personal income taxes take more money from higher income families than lower income ones under 2024 Indiana law. In order to recoup revenue lost from the new property tax relief, cities and counties are very likely to raise their local income tax rates to the maximum or risk cutting public services more than they'll already have to. So you might think, as I initially did, that shifting away from property taxes and leaning more on income taxes would be a good thing. However, it's not. Before I detail why that is, we have to understand our budget and where the money for it comes from. The 2025 certified budget for all taxing districts in Clinton County combined was about $137,839,000. Clinton County will collect about $22.43 million in local income taxes in 2025. The certified tax levy, or property taxes, for all townships and cities, as well as the county, is a combined value of about $55 million in 2025. Tax levies account for about 39.3% of the total 2025 budget. Local income taxes account for less than half that at about 16.3%. And all in all, they account for 56.2% of the total certified budget. The rest of the money for the budget comes from other taxes, funds awarded by the state and federal governments, which are collected through their own variety of taxes and fees, and even things like bonds. Not to forget that Indiana receives about $4 billion more from the federal government than it gives, according to usafacts.org. Now, allow me to explain why relying on income taxes might not be a great idea. Imagine you need $100 to pay for something, perhaps a damaged tire, though it could be anything. You have $500 in a savings account, but your bank won't let you withdraw more than 10% at a time. After withdrawing money from your savings account, you'd have $50 or 50% of the cost covered. You ask a family member to help you out. They have $50, but they tell you they can only give you $25 as they need the rest for their own expenses. Another family member tells you the same thing. Finally, you have $100 and you can cover the cost of what you need. Combined, your family members had $100 on hand, but they only gave you 50%. In this scenario, the $500 in your savings account represents the total value of all the homes in a taxing district, and the act of withdrawing 10% of it represents property taxes. The bank represents the law. By law, local governments are limited in how much they can tax properties. Your family members represent every individual working in an area, and their cash on hand represents everyone's gross income. And receiving 50% or $25 from each of them represents the maximum rate of local income tax. Keep in mind that this isn't how it actually works, as there are a multitude of other taxes, and these rates are not accurate. See, the issue with depending less on property taxes is that decreasing property tax rates will have a far more dramatic effect than increasing income tax rates, at least in Clinton County. Not to mention that income taxes are less reliable than property taxes. And if you want to know more about that, I highly recommend reading Confronting the New Property Tax Revolt by Jared Walksack at taxfoundation.org. In fact, I'd like to share an excerpt from it before we continue. A common objection to property taxes is that they're never paid off, that the thinking goes, one never really owns their home because they will always owe property taxes. Consider a thought experiment. Imagine a new community is formed in a place without government services. The best thing to do, presumably, is form a government because some services are best provided or at least funded by governments. But if this were impossible for some reason, the private sector certainly can provide roads, schools, security services, firefighters, and the like. Imagine homeowners enter contracts for some of these services, paying premiums for police and fire protection, or paying to ensure that their home is on the road grid. Would they value these services and expect to pay for them even though they already paid for their home? And would they, in fact, potentially value them more highly if their home has a higher value? The answer, of course, is yes and yes. Let's reimagine the previous scenario with a couple of the changes that will be made under SCA1 to explore what I mean by dramatic changes. After this, we'll be incorporating additional changes that SCA1 makes, and using real-world values. SEA1 introduces a 10% credit to a homeowner's property tax bill up to $300. In order to avoid complicating this too much, we'll stick with the 10% credit. It also caps local income tax at 2.9%. We'll increase the 50% rate that you borrow from your family to 54.7% to make it proportional to the increase from our current local income tax rate of 2.65% to a new rate of 2.9%. So your budget stays the same at $100. You withdraw $50 from a savings account with $500 in it. However, the bank then charges you 10% of those $50 in a transaction fee, meaning you now have $45. Two family members are able to give you 54.7% or $54.70 of their combined $100. Adding it up, you now have $99.70, falling short of the $100 that you need. Thankfully, there's a cheaper tire that's only $85, but unfortunately, it isn't able to handle the ice and snow on your way to work, and you end up in a ditch. Okay, that last part might not hold up in all actuality, but the point is that we're going to get what we pay for. Cheaping out on essentials like our schools isn't a great idea. Finally, let's use real-world values and add in even more changes. According to the 2023 American Community Survey, the median value of an owner-occupied home is about $122,800 in Frankfort, Indiana. I found one home listed on Zillow at a fairly similar price. We'll look at the real property tax bill and modify it to comply with some of the new changes to see what their 2026 property tax bill could look like. Their gross assessed value was $93,500. Unfortunately, this home was categorized not as a homestead, but as a residential/rental property, so I had to redo the entire tax bill as if it were a homestead property. Thankfully, I have a little bit of programming knowledge, so I was able to create a script to calculate what their tax bill would be using the actual formula. Using this script, I was able to recreate a different homeowner's property tax bill almost perfectly. So although their 2025 bill was about $2,090, it would come out to about $1,029.46 as a homestead property. Please feel free to fact check me on that, but keep in mind there is a very small rounding error here and there. Moving on, many taxpayers saw an average increase of 30% of their assessed value of their homes for their bills payable in 2026, according to the Clinton County Assessor's Office. I wanted to use median values where possible, but will increase their AV by 30% anyway, as it's the only thing I have to go on. This puts their new assessed value at $121,550. If you want to skip the step-by-step process and the details of some of the additional changes SEA1 makes, and just get to what their bill would look like using this assessed value, I'll leave a timestamp for you to skip to. Otherwise, strap in because we're going to do lots of math from here on out. Under SEA1, the homestead standard deduction will be entirely phased out by 2030. Next year, the maximum deduction will be lowered from $48,000 to $40,000, which this property will qualify for. Deducting this amount gives us $81,550, which we will use to calculate the supplemental homestead deduction. SEA1 increases the rate of the supplemental homestead deduction to 40% for bills payable in 2026, up from 37.5%. It will increase by an average of 5.3% every year until it reaches 66.7% for taxes payable in 2031, meaning only a third of the gross assessed value of a home will be taxable. 40% of $81,550 equals $32,620. And adding it to the $40,000 standard homestead deduction will give us a value of $72,620, which is the full amount that we can deduct from the gross assessed value of $121,550. The net AV is then $48,930. The next step is to calculate the normal taxes and referendum taxes using the net AV. The rates seem to steadily increase for normal taxes, but they fluctuate quite a bit for referendum taxes. They could change dramatically next year, especially due to the changes under SEA1, but I'm not sure how I would go about finding the exact numbers that either will become, so I will be using hypothetical numbers. This year's rates for normal taxes was 0.0399150, but we'll increase it to 0.04 or 4%. This year's rate for referendum taxes was 0.002267, but we'll increase it to 0.003 or 0.3%. Normal taxes would come out to $1,957.20, and referendum taxes would come out to $146.79. Now we move on to property tax replacement credits. The rate was in the 3% range in 2025 and 2024. The PTRC rate is a complex subject, and I have no way of predicting what the rate will be in the future, as the rate is set up by the state with data from the local officials, of course. It expires entirely beginning in 2028. We'll use a rate of 3% in 2026, which is lower than it was these past 2 years. In return, that credit would come out to $58.72, making our after-credit subtotal $2,045.27. Those qualifying for a standard homestead deduction or supplemental homestead deduction, once the former is phased out, are entitled to a credit equal to the difference between the normal taxes minus the PTRC and 1% of the gross assessed value of their home. So that would come out to $682.98. Then we must subtract $682.98 from our after-credit subtotal of $2,045.27, which equals $1,362.29. Those qualifying for the previous homestead deductions are also entitled to a 10% credit against their tax liability, so we will reduce that number by $136.23. Their final bill would come out to about $1,256.06 with drainage costs, signaling an increase of $226.60 or 22% from their 2025 bill. There are a ton of other changes, but I won't be going over them. If you want to learn more, I'll leave a few links down below for you, and I'll even leave a link for my script so that you can estimate your property tax bill as well. Even if you don't live in Frankfurt, as long as you know your tax rates and gross assessed value, it'll work. Just follow the directions in the script and click run. If you need help finding that info, go to the Clinton County Treasurer webpage, click on public info, and type in your address. Anyway, despite their tax rates increasing in addition to their assessed value jumping 30%, their final bill only came out 22% bigger. Had we used the same tax rates and gross assessed value under 2025 tax law, the final bill would have come out to about $1,383.40. That's a tax revenue loss of $127.34. Now, let's calculate revenue we'd get if the local income tax rate was increased to the proposed max under Senate Enrolled Act 1 before the changes officially take place, perhaps to prevent future tax revenue shortfall that the Office of Fiscal and Management Analysis predicts. I wasn't able to find the median personal income for those living in Frankfurt, but the median household income was a much more readily available number, so we'll use that. According to the American Community Survey, the median gross household income in 2023 inflation-adjusted dollars is $53,522. That would be about $56,583 in 2025. Taxing it at a rate of 2.65% gives a value of $1,499.45, while taxing it at a rate of 2.9% gives a value of $1,640.91. The local taxing body would receive an extra $141.46 in local income tax, but they'd also lose $127.34 from the changes in property taxes. They'd actually end up collecting an extra $14.12 if they increased their local income tax rates before the changes under Senate Enrolled Act 1 actually take effect. I can't say for certain whether that will or won't happen, but if it doesn't, we will be short quite a bit of money. Before I forget, there's one big problem with that calculation, because according to Zillow, the median listed price of a home in Frankfurt is about $227,000, while the average home value is $203,000. I found a home listed on Zillow for about $210,000. Their home's gross assessed value was $134,600. Their bill in 2025 was $1,483.70. Going through the whole process we did for the other home, their bill would come out to $1,823.49 in 2026, including spring and fall drainage costs. If we use 2025 law with the same tax rates and gross AV, their bill would be $2,017.89. we'd lose about $194.40, a lot more than we previously thought. Even with a 2.9% rate for local income taxes, we'd lose $52.94 from one household alone in 2026. The American Community Survey estimated that 3,442 homes are owner-occupied in Frankfurt. Losing $127 from all of those households would equate to losing $437,134. That's more than the certified budget for Forest, Jackson, Johnson, and Madison townships combined, which only comes out to a little over $400,000. If you're thinking, well, that isn't so bad, the Office of Fiscal and Management Analysis estimates Clinton County as a whole will lose about $750,000 in property tax revenue in 2026, another $400,000 in 2027, and another about $2.4 million in 2028, bringing us to a grand total of about $3.5 million lost in property tax revenue by 2028. If you want to examine the projected property tax losses by taxing districts for yourself, I'll leave a link to the document in the description. If the lit revenue continues growing at a similar dollar amount as it has from 2023 to 2025, and the lit tax rate is not increased before 2028, and we apply a lit rate of 2.9% in 2028 instead of the current one, we will raise an extra $2,475,000 in 2028, but that would still leave us short a little over $1 million by 2028 when taking lost property tax revenue into account. So we'll either drastically cut services or we'll have to raise money through other means. In 2025, 56.16% of the funding for our budget came from property and local income taxes. 44.84% came from other sources. If the budget continues growing at a dollar amount similar to what it has been from 23 to 25, and we account for the lost property tax revenue, 45.89% of the budget will come from revenue other than property and local income taxes in 2026. Using these conditions by my estimates, by 2031, we could rely on taxes other than local income and property taxes for up to 48.36% of our budget. The likely culprit to make up for that, if that's something we can even agree on, is sales and excise taxes and other crazy schemes like implementing toll roads everywhere, both of which disproportionately affect low-income families. If we don't make up for it in other ways, we can only imagine how much more money will be lost. So let's do exactly that. Assuming property tax rates and gross assessed values do not change, meaning we only account for the changes in the deductions and the 10% credit, property tax bills could plateau for lower income families after 2026, or even begin to rise once more, while higher income families will continue to get savings every year. In the example we just went through, that family would save about $127 in 2026, but they'll pay an extra $1.37 in 2027, and they'll only save an additional $24 in 2031 when comparing to their 2027 bill. Now, I'll use my script to plug in numbers for one more home with a higher 2025 assessed value than the last, and then I'll show you something a bit more shocking after that. In 2025, a home with an assessed value of $164,800 had a property tax bill of about $1,843. Modifying the assessed value and the tax and credit rates as previously done without changing the payable year of 2025 would create a property tax bill of $2,484.10. Changing the payable tax year to 2026 would create a property tax bill of $2,240.43, and in turn a savings of $243.67. In 2027, their bill will come out to $2,226.78, an additional $13.65 in savings. Interestingly enough, their bill did not rise. In 2031, their bill would come out to $2,150.78, an additional $76 in savings. I've created a few charts of the estimated tax bills and savings using my program. Those with homes in the gross assessed value range of $225,000 to $300,000 will save the most. Those with homes with much higher gross assessed values will also save a substantial amount. By my estimates, they'll even save about 1.8%, more than those with homes in the lowest gross assessed value ranges. Struggling families in Clinton County might see savings at first, but they could see an increase in their bills starting in 2027 until they finally see savings again in 2031. Meanwhile, more affluent families can rest assured that their bill will continue to decrease year by year. As mentioned before, ITEP already concluded that property taxes disproportionately affect lower income families, but we could see the gap widen even further under Senate Enrolled Act 1. While property tax relief is very much needed, calling for the abolition of property taxes and making sweeping changes that make for great sound bites but hurt lower income families more in the long run isn't going to fix our problems. We need to dig in and find a real solution, one that doesn't arbitrarily benefit higher income families while defunding essential public services. One proposed solution is known as a circuit breaker credit. In essence, it is a credit against a person's property tax bill when certain conditions are met or limits are exceeded, often based on income. For example, even if a family's home assessed value increased by a large margin, but their income did not change, they could qualify for a circuit breaker credit, which would lower their tax bill. Circuit breakers are great for targeted property tax relief, but they also need to be done correctly. Neva Butkus of ITEP even put together a chart of how much low-income Minnesotans benefit from circuit breaker credits. They're able to save large portions of their shared income. It's time for Indiana to bring real property tax relief to those who need it most without sacrificing our schools, our fire departments, our libraries, and all of the other public services that we treasure so dearly. It's time for our local elected officials to speak up against Senate Enrolled Act 1. If they refuse to, it's up to us to vote them out. There was one local official who spoke up against it online, and I even thanked them for it, but they ended up deleting their comment. Their silence says enough. We need leaders who will speak up for us, not leaders who will cower or fall in line. Most certainly not state leaders who create a problem like a revenue shortfall, who then rely on local officials to try to sell you on a solution that will be used against you later. Perhaps like a data center that could be used to help big tech replace real hardworking people with subpar artificial intelligence. If they tell you that they don't want you to finger point, what they're really saying is that they don't want to take accountability for their actions and for the actions of the very people they told you to support and vote for. We might not even ever see the money that we supposedly save under Senate Enrolled Act 1. It won't be used to support our local businesses or as disposable income. It'll be used just to stay afloat. National policies are causing prices for groceries and necessities to rise, and state politicians are using our tax money for luxury vehicles and helipads at their homes. Meanwhile, we have local officials who are part of the same political party who aren't sounding the alarm. For the record, I believe local officials get blamed far too often for the actions of state and federal leaders. But if there's one thing I can criticize them on, it's their silence. And please, don't lecture me about both sides. Yes, while I believe one party has many faults, it also hasn't held meaningful positions in this state for decades, unlike Republicans. This is coming from someone who is no longer a part of any local political party. Regardless of the failures of any given party or elected officials, we the people have to stop admitting defeat, stop believing that someone will save us, and get to working on solutions, speaking out, and demanding our elected officials do their job, working for us. Start thinking about running for something locally, and if you want help, reach out. If I feel like you're someone who will genuinely help and speak out, I'm sure we can figure something out. Before I go, I have two more things that I'd like to talk about. You might be wondering, so what can we bring in to grow or improve Clinton County if not a data center? People say no to everything. I haven't been part of every discussion, so I can't speak on every topic such as the solar panels. In my opinion, we can't compete with other cities or counties when it comes to entertainment, restaurants, and other similar businesses. That's definitely not to knock the ones that we do have down. It's just that we have seen quite a few shut down, probably because our residents don't have enough disposable income. As recently as July 22nd, Jordan Brewer, president of the Clinton County Commissioners, noted that many people refer to Clinton County as the place to work, but wondered whether it should be known as the place to live. I'm not entirely sure what his vision is, but this topic has been on my mind for a while. Investing in and expanding our public services like bringing back our zoo and installing more fencing or barriers, or subsidizing or providing free mental health care could make Clinton County a really attractive place to live. If we can make it a great place to live, we can lessen the burden of property taxes on each family as more people move here. while growing the amount of potential patrons of our local businesses. This is something that I might have to explore in more detail in a different video, so let me know if that sounds interesting to you. Finally, I just want to say that I don't hold any position of power. I don't have any access to any sort of special documents. I'm just a concerned citizen who works a full-time job separate from any of the media that I publish. I haven't earned a single penny from any of my videos, and in fact, I've spent quite a bit of my hard-earned money and countless hours of my free time to try to bring you all the information that I have thus far. So no, unfortunately, I don't know the full extent of what Senate Enrolled Act 1 will have on our communities. At best, these are only estimates. I ask once more that you please read the articles from the Institute on Taxation and Economic Policy and the Tax Foundation, and review the documents that I'll leave for you in the description. They're excellent resources to begin the process of brainstorming ideas for real solutions and understanding the impact of Senate Enrolled Act 1. Thank you for taking the time to watch this video. Please share it with someone that you know in this community. My name's Fabian, and I hope you have a wonderful rest of your day. Until next time.